Everybody, it's your boy Illuminati. Today is June the 26th, 2020, and let's get right into it. Today's video is going to be about the macro picture to explain how COVID-19 is disrupting the global markets. And this is going to be my opinion. I'm not a financial advisor, but it's just my analysis that I'm providing for educational purposes. And I'd encourage you to do your own research before making any investment decisions. And again, I'm not a financial advisor. So I find this to be really interesting to kind of think about how is the world going to respond to COVID-19 in terms of how it disrupts the financial markets and what the response of that is going to be, and how should we prepare ourselves to be on the right side of that response. So there's two major effects I think that's going to happen. One will be to the world and one to the US. And I think there's a clear distinction between the two. And so I'm going to talk about the world first, and then I'll talk about what happens in the US. And both the effects are eventually going to be positive for the crypto space, I believe at least. And specifically for Stellar and possibly Bitcoin. And so let's go into it. I have quite a bit of information to cover. I think if you just sit back, relax, and just let me paint this mental picture for you to kind of consider, do leave some comments, some feedback on whether you agree with the analysis or if you disagree. All right, so here we go. So COVID-19 is disrupting the whole world, and in order to find out what that disruption is going to be like or what the effect is, I did a little bit of Googling, and I like this one website here, theworldbank.org. They put out a report that's free, and you can download the major highlights of it. And I'll just read the first point. The COVID-19 pandemic is expected to result in a 5.2% contraction in global GDP in 2020, the deepest global recession in 8 decades, despite unprecedented policy support. So what that basically means is, because due to COVID-19's effect mainly being social isolation, right? And when we're isolated, we're not engaging with businesses more, and the output of these services and goods will be decreased because there's less demand. So globally, if there's less demand for services, then there will be a decrease in GDP nationally for each of these countries. And so economies are going to suffer, basically. Now, if there is a decrease in goods and services, right, there's going to be another effect. And to illustrate that, I want to first read this point right here. It says, commodity exporting emerging markets and developing economies will be hard hit by the adverse spillovers from sharply weaker growth in China and by the collapse in global commodity demand, especially for oil. That's a very important line. So because COVID-19 is disrupting businesses, goods and services, it's disrupting the demand for goods and services. Due to social isolation, there's less demand for goods and services. And due to that, the underlying commodities will have a decrease in demand. So there'll be a global decrease in commodity demand. Especially the biggest commodity to be affected will be oil. And so this talks about that. It just shows some good graphs to see how energy, agriculture, and metals in the month of March of this year were affected by the COVID situation, and how crude oil market has been the most affected by the pandemic in terms of percentage decline in oil demand. Now, why is that important? Well, because we must understand that if there's going to be a massive decline in oil demand globally, well, it's going to affect one thing in particular, and that's the US dollar. Why is that? Because the US dollar is related to the price of oil. And I just want to show you this link to kind of explain how the correlation of oil and currency, especially the US dollar. So countries that buy crude oil and those that produce it exchange US dollar in a system called the petrodollar system. And what's important to know is that if anyone in the world wants to buy oil, they have to first get US dollars in order to purchase it. They can't purchase it in any other currency. So they'll have to convert their local currency to the US dollar, called this petrodollar system, and then they can buy and sell oil, right? And so there's a very specific relationship, and it's an inverse relationship, meaning that if oil price is going up, then generally speaking, the strength of the US dollar is going down. And so to understand that, we look at this chart. It shows the US dollar exchange rate against the world currencies and nominal oil prices from 1983 to 2011. Now, these arrows are misplaced, so don't follow these arrows. But these three lines over here are the US compared to other currencies such as the Japanese yen and the euro. And this dark line right here is the price of oil, right? And if you focus right here, you'll see that as the price of oil started skyrocketing, the purchasing power of the US dollar in relative to these other currencies all decreased. You see that? Slightly, they're all decreased. And so what's happening now? We just talked about how because of COVID-19 and the decrease in goods and services, the demand for goods and services, the underlying commodities that go into those goods and services also have a decrease in demand. And the biggest commodity to be affected in this decrease of demand is oil. So due to a huge decrease in demand for oil, it will cause oil prices to drop. And we can also appreciate that if we look at this chart right here. This is the US dollar and crude oil chart, and I'm going to focus on 2008 to 2009, and that was when we had the last financial crisis due to the housing market collapsing in the US. But in that problem with the economy, which is similar to now, there's a problem with the economy right now. We saw the price of oil decrease. You see how it dipped largely, right? And as the economy recovered, it started to go up and then come back down. But this drop right here is what I want to focus on. And we noticed that happened right here as well. As the COVID-19 started to grip the world, there was a massive drop in oil value and oil price, right? The 1 barrel of oil decreased rapidly. And what I expect is the price of oil for a barrel of oil to be around $10, anywhere between $10 to $15. So in this price range right here. So what does that do for the US dollar and its status as a reserve currency? Here's what I think is going to happen. See, as oil price will decrease, then the demand for the US dollar globally, it will increase, because it makes sense that countries will want to stack up on barrels of oil when the price is low, right? It just makes more sense to stock up now when the price is low. And so even though the demand for the goods and services is not there right now, but when they do start picking up, this oil is available that they can resell back into the market for a higher price, or they could just kind of help their own economies with it, right? So countries everywhere around the world will be trying to get the US dollar to buy oil at these low prices as the price of oil keeps dropping. So that should increase the demand for the US dollar, which will make countries want more US dollar in their reserves, right? And so that increased demand for the US dollar will be a positive effect for the value of the US when compared to other currencies like the euro, the yen. What I expect, and this is the euro USD chart, what I expect to see is the US dollar will continue to increase in strength. So this will drop down here because if it went up, that means the euro dollar was becoming more valuable. But I think the US dollar will have more value. So we'll most likely see this drop, and at least to this level right here, but I suspect it'll drop even further, maybe down here to 0.96, possibly even to 0.9 over there. And that's across the board. I think the US dollar is going to be stronger against the Canadian dollar as well, against the yen as well. And so because of this strength in the US dollar globally, I think the US dollar maintains its reserve status. People will still want the US dollar worldwide because A, it will be stronger than other currencies. And the reason for that is because it's inversely related to the price of oil. So, and as oil stays low, its value is going to stay high. The US dollar's value is going to stay high. And to maintain that purchasing power, other than to purchase oil, there are other assets that generally maintain the purchasing power or the USD purchasing power, I think are also going to increase in value. And this is where I see the argument for gold and silver and Bitcoin, because Bitcoin is considered digital gold, to increase as well. Because as people are buying more US dollar currency, the common person is not going to be trying to, they could just store the currency, or they could put it in assets that increase higher than the rate of increase of the US dollar, meaning that, for example, like gold, right? Gold will always adjust for inflation, and so will always maintain the purchasing power of the US dollar. And so that's where I think gold goes up, and subsequently silver as well. So if we just show a price, a chart of gold, it's right now breaking the previous all-time highs, and I expect it to continue to go up. How high? I'm not really sure. Possibly around anywhere between 3,000 to 4,000, maybe even 5,000, but I can't be certain. But I definitely see it breaking the previous high of 1,900 and somewhere in the realm of 3,000. So that's for gold. And similarly, for the young generation, their digital gold, being Bitcoin, is also expected to increase in value as well. And specifically why I think Stellar will for sure increase in value is because as people are going to want to purchase the US dollar and have that power to purchase other supplies in the best currency, I think merchants are going to want to ask for the US dollar worldwide, and this is regardless of oil. I think people, regardless of their natural currency, they might prefer to have their products sold in the US dollar because they're going to get higher value for it. And so a platform that can make that conversion very easily for even micropayments, such as Stellar, I think is going to be very valuable. And that's why I see Stellar rising as well, and increasing to and staying well above its previous all-time high as well. And so that's going to be very exciting for Stellar because it can facilitate the process of USD traveling around the world in the form of USDC token on the network. And it can also hold Bitcoin on the network. And of course, it has Stellar itself on the network, and Stellar is required for each transaction. So that's why I see Stellar being extremely valuable in response to the global reaction to the current markets. All right, so that is the global picture. In the US, let's talk about what specifically is happening in the US. Okay, so for that, we have to understand this term called velocity of money and how it affects inflation. Inflation depends on money growth and the velocity of money. The velocity of money equals the average number of times an average dollar is used to buy goods and services per unit of time. So prices increase when the product of money supply and its velocity grows faster than the real GDP. If that's a little confusing, you can take some time to read this again, but let me show you this chart, which is the money supply chart, right? And as you can see, it's constantly been increasing, but specifically here, since this crisis, it's skyrocketed up, right? Now, why is that important? That's important because it's telling you that there is more money more US dollars in our economy. There's more money printed into existence for us to use. However, this is the chart of the velocity of money, right? That means the exchange of money between people or institutions. And the exchange of money has been rapidly decreasing. Now, why is this important? This is important because in order for inflation to occur, which is always the biggest concern, whenever people see this huge increase in printing of money, right? They're always like, oh my gosh, hyperinflation. We're all going to be hit with hyperinflation and our dollar is not going to be worth anything. But that's not true. See, for that to happen, you need to have a higher velocity of money, right? And the trend right now is going down and most likely going to continue going down. And why is it going down? Well, think about it, right? We said globally there is a decrease in goods and a demand for goods and services, right? Because of social isolation. Well, that's true in the US as well, too. There's social isolation in the US. There's a decreased demand for goods and services here. We've already heard about a lot of bankruptcies affecting retailers and businesses, small businesses being permanently out, having to close down. And also we've heard of record unemployment in the US as well. I should probably get that figure for you. Let's use this and let's just see unemployment currently in the US. Unemployment rate is, where are we at? We're at somewhere, so 13%, if I've got this correctly, 13% for May 20, and so it's a month behind. And why that's important is because unemployment is high, and just to give some context, the Great Depression had unemployment at 25%, I believe. And so why that's important is as unemployment is high, people are not earning. Therefore, they're either trying to save or spend less, which means both saving and spending less causes a decrease in exchange of money, right? And that means there's a decrease in the velocity of money. So if there's a decrease in the velocity of money, no matter how much money you print, right, inflation's not occurring right now. I mean, yes, there's a lot of money, but there's no inflation currently because there's no demand for goods and services. And so prices have to drop down when there's less demand. And if people are not buying goods or exchanging or engaging in services, then they're not exchanging money. So there's a decrease in velocity of money. So right now, inflation stays low, right? All right. So prices stay low as demand stays low, right? That makes sense, right? So in the US, I expect prices, generally speaking, to get lower for uh, everything. So I expect food prices to either stay the same or get a little bit lower. I expect car prices and home prices, especially home prices, to get lower. And we'll touch a little bit on the housing market, because generally in these recessions, which we are in, these recessions generally cause about a 30%, at least a 30% decrease in the housing market, 12 to 18 months after, on average, after there's been a massive amount of money flushed into the market, or after there's been an announcement of a recession, right? So if we go back to the chart, we can just look at this chart right here. This was the last recession, right? And it started in 2007. And we saw this huge increase in money to address that recession, right? And during this, huge increase in money, we saw the housing bubble burst, right? That was the 1.0. And this is a good article for you to read if you're interested, why the housing bubble is 2.0 is about to burst. It was written in March of this year. And it showed how there was a crash during the last recession, right, in prices. But then there's another bubble in the housing market currently going on, right? And we can expect this to correct as well down to this part over here. So currently it's at what? Above 150, right? So it's going to correct at least 50% down to 80% here. No, not 80%, sorry. That's 100%. So it's going to go from 150 to 100. It's a bit less than, so it's about 30%. I'd say somewhere between 30 to 40%, right? Correction in housing prices. So we can expect that to happen. And when is that going to happen? That's most likely going to happen next year. You're going to see that somewhere near the end of next year, mid to end of next year. So I'd say going into the summer months, or maybe in the fall months of next year, you're going to see the housing market crashing as well. And similarly, that also pertains true for the commercial real estate, because if you think about it, if businesses are being bankrupt, if there's less demand for goods and services, people are getting used to social isolation, so there's going to be less demand for commercial real estate as well. And so that price is also going to drop. All right, so in the US, due to the high unemployment rates that we've talked about, currently it's at 13%, but we can expect it to get higher, at least into that 25% as the last depression. Due to the housing market crashing, prices going down in value, people having negative equity in their homes, we can expect more people to be on welfare, to be in terms of poverty. We can expect poverty to increase in the next year or two. Now, to address this, the government might produce more stimulus checks, right? And will that become a forever thing where there's universal basic income? Probably not. I don't expect that to be the case, but we might see more of these stimulus checks coming around, right? And so that, although that's probably going to help with people just surviving in terms of buying food, maybe pay rent, or pay their mortgage, maybe not be able to pay their mortgage. So maybe they'll have to sell their home and start renting. But they'll be able to hopefully survive with these stimulus checks coming in. But the problem will be that there'll be a need for the government to eventually help bring the U.S. Population out of this recession, out of this maybe even a depression, right? And so what are they going to do? Well, what did they do last time, right? What ended the last Great Depression? Let's look into that. Well, it says here the Great Depression was the worst economic crisis in U.S. history. Um, and where does it say? Yeah, it says on the surface, World War II seems to mark the end of the Great Depression, right? Now, I found that really interesting. Why? Because back then they said that due to the demand that the war created, for supplies needed for the war, that created an increase in goods and services, and therefore that brought up the GDP and helped bring the country out of the recession. But when the war ended, the same, the demand for the goods and services decreased, and they were wondering what to do. So initially, they increased the tax rate. They went to 90%, thinking that would help, but that didn't help. And eventually, what they did was they reduced taxes. So there was less regulation, less taxes. So there was more freer markets, lower taxes, and the budget was a little bit more balanced, and that allowed them to come out of the recession by 1946 when unemployment dropped to just 3.9%, right? So I think what's going to happen here is that we're going to see something similar, but maybe we've already seen that. I'm not saying that we have to worry about a war. What I mean by that is that maybe we've already started responding to a war. So, this article, fighting coronavirus feels like fighting a war. That might bring us together. So it says here, last month, this was in April of this year, last month while COVID-19 pandemic began ravaging the United States, President Trump invoked wartime powers to direct the manufacture and distribution to face masks and ventilators. The decision implies a metaphor suggesting we are at war with a silent, faceless enemy that has infiltrated at least 184 countries in every U.S. state. Terrifying as that may be, it also gives people around the world a rare opportunity to come together. So I find that interesting that, the cure to the last Great Depression was a war, and currently, is our recession due to COVID-19, or is COVID-19 the war that's going to help us come out of this recession? Some people might say the markets were already bloated. We were in a hyper bubble. It was going to crash. It just so happened to coincide. This was like the pin to the bubble. The COVID-19 was a pin to the bubble. And so the response to COVID-19 might be our war, meaning like this response to how the government responds to the effects of COVID-19 is going to be how we come out of this recession. And so what are going to be the response of the government? Well, I think what they're going to do is they're going to, similarly how in the past they eventually realized that they needed to have freer markets, a balanced budget, and lower taxes. I think we're going to see something similar to that, but the increased demand for goods and services, I think, is going to come from infrastructure projects. I think the government is going to try to pour tons of money into getting businesses to increase the infrastructure of the U.S., roads, maybe building more hospitals, because to address the various ailments that are going to be exacerbated as we deal with this COVID situation. And so that increased infrastructure demand, I think, is going to create more jobs, and it's going to create a rebound in the economy in the U.S. And eventually, as more people get back to work, right, due to the government coming in and encouraging a certain sector for businesses to participate in, specifically infrastructure, that increase in jobs is going to encourage people to start spending more, right? Then we got to start worrying about what we talked about earlier. When people get jobs, the unemployment rate goes down and they're getting eager to spend more. Well, what happens? Well, then the velocity increases. But we know if the velocity is going to increase and there's more of the money available for it to increase, well, then what happens to GDP? I mean, not the GDP, sorry. What happens to prices? Prices increase, and in fact it increases rapidly, and that's where hyperinflation could happen, right? And so in order to combat that hyperinflation, what I think is going to happen is the U.S. or the government or the Fed, I think, will increase interest rates to combat inflation at that point. Um, and so there's that danger. Well, if they increase interest rates like previously, it's just going to discourage businesses from participating in the economy more because it's going to be costlier to take a loan. I don't think that's going to happen this time around because prices are going to be so low due to what we discussed earlier. Due to this decreased demand from COVID, prices are already going to be so low that when the interest rates come back, start to get increased up slowly, prices are going to increase, but they're not going to discourage businesses. Businesses are still going to thrive and be healthy. In the meantime, I think for people to survive that period of a high unemployment rate, a decrease in goods and services, possibly a depression, for people to maintain their purchasing power in the U.S., I think it's same thing what people are doing in the world during this time, which is you need to be considering the assets of gold, silver, Bitcoin, and Stellar, because as interest rates goes up, right? Until interest rates grow up. Sorry, these assets will hold their value, and they'll hold a purchasing power. And as interest rates goes up, then you're going to see a decrease in gold and silver, and at a point also, I think Bitcoin will go down as well. So that is my big analysis, macro picture analysis. For how I think COVID is going to affect the world and the US specifically. I hope it painted a clear picture and I explained each point carefully. For a massive recap, and if you didn't want to listen to the whole video, what I think is going to happen in the world is COVID-19 causes a massive decrease in GDP of the world, meaning goods and services decrease, meaning the commodities that are used for these goods and services also decrease in demand, the major one being oil. And because oil's price decreases, the inverse effect of that on the US dollar, because of the petrodollar system, causes the US dollar to increase in relation to all the other currencies around the world. This preserves the US dollar's reserve status in the world and maintains its purchasing power. This will consequently cause people to maintain that purchasing power by converting their US dollars into other assets that can kind of hedge against inflation, which would be gold, and for this generation, digital gold, which would be Bitcoin, and also for Stellar, because Stellar is a platform that can hold any asset on it. So regardless of whether you want to be holding US dollars, whether you want to be holding Bitcoin or gold, maybe in the future they'll tokenize oil as well on the platform. So since this payment rail is so easy to be used globally, Stellar's value is also going to increase. Now, in the US, because of COVID-19, a decrease in goods and services causes bankruptcies, causes businesses to shut down, which increases unemployment and causes the unemployment rate to skyrocket, which this causes a decrease in the velocity of money in the US. Less people are spending. There's less exchange of money. So regardless of how much money the government pumps into the economy, since there's less money being exchanged, there's less likely for inflation currently. That causes prices to stay low as there's decreased velocity and decreased demand for goods and services. This will eventually trickle down and affect specifically the housing market, and that's going to crash in about 12 to 18 months in the US from March. And also commercial real estate is also going to crash. At least both are going to come down at least 30%. Both due to the decrease in demand and housing market crashing, there's going to be increase of people on welfare. There's going to be an increase of people requiring stimulus checks, and those stimulus checks might increase in duration. We might get a few more of those. But eventually, the government is going to need to do something to get us out of this recession. And similar to the last time we had the Great Depression, what the government eventually did was reduce taxes, they reduced regulations, and they tried to balance a budget, and they provided, or not, they didn't provide, but there was a cause for increase in goods and services at that time, which was a World War II. But currently, our war, quote unquote, the war, is how we fight against COVID. So maybe there might be, due to handling COVID in the future, the government might say to prevent such situations, we need a better infrastructure in our country. And so that demand for infrastructure to improve, such as with roads and better housing, and the housing might be backed by Fed-backed loans. This increase now in projects and demand for goods made by the government by saying that we need an increase in infrastructure will bring more people back into unemployment, reduce unemployment, which will cause a rebound in the economy. But to prevent hyperinflation, the Fed will start increasing interest rates. And since prices were already so low, I don't think businesses this time will be hesitant to continue taking loans out. And so that should bring the U.S. economy back to its new normal. And in the meantime, in the U.S., for people to maintain their purchasing power through the tough times, they would most likely kind of be in gold, silver, Bitcoin, XRP, XLM. XRP maybe, but definitely Stellar. All right. So that's a lot. Where are we at? How many minutes are we? 37 minutes. Hope you all enjoyed that. Leave some feedback. Let me know what you think. I think we nailed it. And I'm out.